Hi, and welcome to Your Prosperity, a podcast series on financial topics including tax, wealth creation, superannuation, lending, audit, and many other things that we deal with here on a regular basis at Prosperity Advisors. As with all financial podcasts, any advice you hear in this is general in nature and not to be relied upon. Please contact us for any specific advice. Hi, and welcome to the podcast. It is the 25th of July, 2022. My name is Brendan Campbell, and I'm here with Gary Dean, who's one of the financial advisors here at Prosperity. And we're going to talk to him about the current investment market and what's happening at the moment. There seems to be a bit of volatility, but rather than me tell you something I'm not an expert in, we thought we better get an expert. So, Gary, welcome to the podcast.
Thanks for having me, Brendan. It's a pleasure to be
here. Yeah, very good, very good. Gary, I guess, first of all, what's been the cause of this volatility in the market, and what, probably the last 6 months, it just seems to be all over the place. What's been the reason for that, or the underlying issues about that?
Yeah, look, it's been a very exciting and I guess volatile past 6 months in the markets. I guess in the lead up to Christmas, we saw some fantastic returns in the 2021 year. We saw the Aussie market was up around 17%, and the overseas markets were up close to 30% for last year. But yeah, everything then changed in January when we came back after the break. We saw a major sell-off in the IT sector in the US. So there was a real shift out of a lot of those growth stocks in the market and more to value-based stocks. We started to see bond yields rise, and that change in the thinking of the market was really on the back of the expectation that interest rates were going to start to go up faster than expected. And then we moved into February, and probably a spanner in the works was the war in the Ukraine and Russia. So that really spooked markets for a while as well. So it really heightened the inflation concerns of the market. The Russia produces 10% of the world's oil and gas. So that really
so therefore fuel prices were doubled at the pump. That seems about right.
Yeah, through the roof. So Australia was a bit protected because we've got a lot of commodities, and a big chunk of our share market is in resources. But it certainly heightened the inflationary environment around the world. And then I guess to make things worse, we then saw China go back into lockdown just with COVID restrictions and tighter government regulations, which really put the handbrake on their economy. So
is that, I mean, you're saying Australia was less impacted, so there was a bigger reduction in global markets, or, the bigger countries, obviously, but there's a bigger reduction there than there was in Australia?
That's right, yeah. Australia's market is a big proportion of it is resources and commodity stocks, and that makes up a large part of our index. So given that the price of oil went up, that just gave a little bit of a protection for the Aussie market. But we still went down, but certainly not as much as the US market. Today, the index in the US is such a large percentage of some of those really big technology companies like your Apples, your Amazons, Alphabet, Microsoft. They really do now make up a large chunk of the market.
And obviously, markets just don't go up every month. They do come down like every market. It's just obviously everyone gets a bit nervous when it does come down, but I guess the idea is always is the long game, not the short game on these sort of things. And if you're looking at it month to month or year to year even, there's going to be volatility in that. So with that in mind, where will 2021 or 2022, 2023 go, Gary? I'll hold you to account in this in 12 months and want an exact number, please.
Yeah, look, there's no doubt that the market at the moment is very sensitive to inflation data. So that last number that came out in the US of 8.6%, that really wiped a big chunk off both the US and the Aussie market. So we're still going to see that inflation sensitivity going forward as we're going through that cycle of increasing interest rates. But I think the difference this time around, Brendan, is that households are sitting on a lot of cash. We're in lockdown for a couple of years, and households weren't able to spend on all the normal things like holidays and going out to restaurants and the like. So there's a lot of cash that's built up. A lot of households are ahead of their mortgage repayments. So I think that will certainly help things this time around, in that even if we do get a bit of a downturn, because households have got all that built up cash, that might sort of ease the what we might call a minor recession or a minor slowdown. And
Yeah,
probably the other factor to remember too is corporate balance sheets are still in pretty good shape. So the last reporting season was pretty healthy, both here in Australia and overseas. We've got another reporting season coming up next month. But corporate balance sheets are fairly strong at the moment. So I think that those two factors combined, might mean that we just have a more of a mild downturn rather than a severe recession. Here in Australia, the inflation rate's not as high. We're sitting on 5%, so it's not quite as bad as things in Europe and the US. Plus, we will have some benefit from the tailwinds of China as China starts to recover, which it did during the month of June.
so it's not all doom and gloom, and Australia's probably positioned quite well at the sound of that. We're sort of at a good spot with Asia there, and with all the commodities we've got and resources. It's we didn't see the big runs that America had with their tech stocks, which have all come off the boil a bit, but we're probably not in a bad spot.
Not as bad as overseas, but in saying that, it's important for Australia to really diversify our trading partners going forward. We can't purely rely on having most of our exports with China, and I think a lot of industries have realised that during the last year or two with COVID. So we do have to diversify in that area.
And what methods or tools do you talk to clients about when they're reducing that risk in investing? Because obviously it's not just, you should buy CBA stocks or Google stocks or whatever it is. You obviously diversify, and what methods do you use, and how do you talk us through what you talk to a client about with that in regard to that?
Yeah, look, I guess we look at to diversify. That's the key measure of how to reduce risk in an investment portfolio. That's been around for many years, and nothing's changed in our way of thinking. But I guess diversification in an investment portfolio can happen at a couple of levels. It's diversifying across different asset classes, so it might be bonds, shares, property, infrastructure, but it's also diversifying within an asset class as well. So there's no point having all your money in one Australian share or all your funds in one managed fund. You need to make sure that you're spreading the risk across a range of different investments. And I guess a managed fund is a great way of doing that. You own a range of different assets in the fund, and it takes away the decisions by the fund manager are based more on logic and not emotion. Us as individuals, we can get very emotional about our money and worked up and make irrational decisions. Whereas if you've got a fund manager helping you in that area, they can really base those decisions more on logic and then following a disciplined approach to investing. And I guess for us, we look at setting a strategic asset allocation for our clients and then tweaking that month to month, depending on changing market conditions and making minor adjustments to the asset allocation. But that's the key way of managing risk. And I guess any portfolio is never a set and forget. If you just leave a portfolio, let it drift, you could find yourself in a very different risk position in 2 or 3 years' time if it's not managed on a regular basis.
And I guess from I guess being a client in this regard as well of the firm, it's not just one fund manager either, is it? It's maybe spreading over a few fund managers to get even more diversification through that. With some fund managers, from my understanding, are good at certain areas and focused on certain areas. So and when you're doing that, I guess, because you're looking at there's lots of fund managers out there, and if you're putting a bit with each fund manager, how do you determine who you put the money with with that fund manager?
No, that's a really good question. So we really look at things at 2 levels. First of all, we look at the quantitative side of things. So what's been the fund manager's track record? Do they have a long-term track record? Have they been able to demonstrate consistency around outperforming the market? So there's the metric side, but then there's also the quality side. So who are the people running the fund? What are their systems? What are their processes? That's just as important. So you could be in a really strong performing fund that's done well over many years, but all of a sudden, if a couple of the key people running that fund leave the organisation, you've got to reassess whether that fund's still appropriate for your portfolio. So that sort of the quantity side, the quality side, blending that together, and then working out, okay, if we have these mix of funds, what's the correlation? Are they all doing the same thing, or are they different? Because we want to keep that correlation as low as possible so that we're minimizing the risk across the entire portfolio.
You're diversifying within the diversification.
That's right. That's a good way of putting it, Brendan. Yeah.
Yeah. And so if we're that's sort of using you effectively as an active manager of the fund managers and getting that asset allocation and the strategy right. What's, apart from, as you said, a set and forget issue, what's the regular punter out there do wrong? How do they normally get this wrong? Because a lot of people would say, oh, you buy the index, or the Buffett approach, buy the index, or buy BHP. You can't go wrong there. Like what's the mistakes people make?
Yeah. Look, it's probably the biggest mistake. It's the emotional behaviour. So I actually did a study in the US where they looked at like 20 years of returns of the average investor, what their return and what the market was. And the difference was like 11% was the market average return. And the investor that went in and out of funds ended up with 4% over that same time period. So that was showing that people were making decisions based on emotional behaviour. So when the market was going up and was at its highest point, that's when all the money was flowing in. And when it was at its lowest point, that was when the money was flowing out. So that's probably the biggest mistake. It's that emotional behaviour. We've got to remember that the share markets do not move in a straight line. And if you miss the best 20 or 30 trading days over, say, a 10-year period, well, your average return could be easily cut in half over time. So probably trying to time the market. And the other one is just, look, it's blocking out the noise. In the media, put the news on at night. The reports are the share markets drop 2 or 3% in a day, but often the next day the market bounces back, and the story doesn't even make the news.
Yeah.
So when was the last time we heard a news story where a company paid a record dividend to shareholders? Like that's never been a news story, whereas
bad news sells.
Bad news sells. So I think it's that ability to block out the noise and not make those decisions based on emotion.
So you're saying everything I hear in the media isn't true?
I'm not saying it isn't true, but they're very selective on what they report on. That's for sure.
Yeah, absolutely. And you see that all the time. Saw something the other day on the news. It was Brisbane predicted for the massive reduction in house prices due to this and that. And it's always a prediction, and with the story they sell, there's probably one saying it's going to go up, but they don't report that. They just report the one that says it's due for its worst ever fall in 50 years or something like that.
Probably the other thing I'd say too, Brendan, is that, like, if you're nervous about investing and you're doing it for the first time, you're looking to put some cash into a portfolio, a great approach is just to dollar cost average, which is basically where you're taking installments of your money and putting it into the investment over a period of time. So you might do that over 6, 12, 18 months. So rather than taking all the risk up front and all of a sudden, a COVID type event happens a month later and your portfolio takes a major capital decline, do it over a period of time. There's no guarantees at the end that you'll be better off, but it's a better way of managing that risk and trying to smooth out the volatility.
Absolutely. I want to touch on one other thing before we wrap it up, because it is a short podcast series. Ethical investing, we're hearing more and more about. Can you just talk us through? It's just probably something that's been around the last couple of years, but seems to get a bit of tailwind when it's in the media of all places. But it's out there. What's ethical investing? Should be looking at it. Is it bad news? Is it good news?
Yeah, so we're hearing more and more about this in the media. Our clients are asking us about it, and we've actually taken the strategy of putting ethical portfolios together for our clients where they've asked for it. It's basically really trying to blend those environmental, social, and government issues with a financial return. And I guess an ethical investment really has the traditional negative screen. So sectors like fossil fuels, addictions like alcohol, tobacco, gambling, weapons, forest logging, animal rights, all those sort of things are screened out of the investments. And then there's the positive screens. So some fund managers out there looking to put in investments which are clean energy, green energy, green technology, all those sorts of things. So that's really how they operate. And look, in Australia, the market's becoming a bit more developed now, so you can get ethical investments across bonds, Aussie shares, international shares. So there's a lot more choice out there, and there are plenty of funds that do have a long-term track record.
Is that just reducing your opportunity though? If you're cutting out certain shares, like if there's a mining boom, you're missing it. Like, is that
exactly
the risk?
right, Brendan? And I guess if you look at the last 6 months, because it's been the resources sector that's sort of held up and done reasonably well, the ethical investments would have underperformed. So I guess as an investor in that space, you've got to be comfortable that you're going to have periods of underperformance because you're cutting out large segments of the market. But long term, I think as long as you've got the right time horizon and the right approach, there's no empirical evidence to say you'll be worse off as an investor. But
and as you say, if the market's big enough, there's still investments that are ethical that can make good money.
That's right. Absolutely. Yeah. So
that was good, Gary. Appreciate that. As this is more than the normal financial podcast we do, which we talk about things, I think you've got to do official disclaimers. So I might let you get that in before we wrap it up, and then.
Yeah. So just a disclaimer, just that the information in today's podcast is general in nature. So the content doesn't take into consideration your personal objectives or financial situation. And you need to consider your personal situation before making any decisions.
Thanks, Gary. Thank you, everyone, for joining us today. Hope you enjoyed the podcast. Gary, for more information, email, how do they contact you? What's the best way?
Yeah, so gdean@prosperity.com.au. Just send me an email. We have a monthly newsletter that we send out. So if you're of interest in that, we're happy to put you on the mail list and go from there.
Fantastic. And that's DEAN for those playing at home. And obviously myself, Brendan Campbell, so bcampbell@prosperity.com.au. So for more content similar to this and everything else we do at Prosperity on a variety of topics, whether it be financial investments or tax or audit, lending, whatever it is, please jump on the website, prosperity.com.au. Follow the links from there. For more information about Gary and myself, it should be up in the notes section of the podcast. Jump on there and have a look at that, or just head to the website. Thank you, everyone, for joining us, and thanks, Gary.
Cheers. Thanks, Brendan.
Thanks for joining us for today's podcast. Hopefully you liked it, and if so, please give us a few stars, like and share. And if you'd like to follow the series, please subscribe and pass any information on to your friends as well if you think they might like it. For more information about who we are, head to prosperity.com.au and follow the links.